Hello, everyone, and welcome back to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options. Some of you might be familiar with me by now, but for anyone that might be joining us for the first time, welcome. It's great to have you with us. As always, we need to cover off some important housekeeping details about the session, and then I'll introduce Rob. So first and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there, or certainly feel free to take a screenshot of it now if you like. That's the main point to take away. Now, again, I'm sure most of us out there are likely familiar with the Q&A process. Rob will go through his general presentation and then open it up to questions with the time remaining. If we're unfamiliar with that process, or again, maybe joining us for the first time tonight, please take a second to review that slide to understand what the process is for asking questions. All right, that covers off the housekeeping details per usual. Earlier in the trading day, it seemed as though the market wanted to break lower. However, the rally into the close indicates that the market's waiting on the Fed meeting tomorrow. Every day, I just try and understand what I'm being fed, and then the next day it sometimes seems to flip on its head. But that's why I'm here listening to Rob, just as most of us might be in a similar boat, always looking for Rob's insights on things. So I'll stop rambling on at this point and introduce the man of the hour, Mr. Rob Roy.
Thanks, Zach. And was that a pun intended when you said the things you're being fed when we had the Fed announcement coming tomorrow? So
unintended.
Freudian slip. Everybody can see from the background that I am back up in the mountains because it is absolutely gorgeous in the mountains this time of year. This is where you get the little bit of the last warmth during the day, but it's nice and cool at night, just before the seasonal change, and all the leafers come up here to watch the beautiful coloring of the leaves changing that occurs in October. So those of you that have watched before know the background. If you're new, this is not the normal office background in the dragon capsule, as I call it. All right, so let's get talking about the market. I think everybody can see the chart. At this point in time, as Zach mentioned, you can see on this bar today, we did trade quite a bit lower earlier in the day, and then we rallied to the close to where we have a doji here. So we'll see if that means anything as far as tomorrow. I think it probably does. It clearly states that there was indecision going into the Fed announcement. Lots to talk about, as we were off last week, so we got 2 weeks of stuff to catch up on. We'll talk about the market pattern in a second, but just dealing with the Fed tomorrow, there's a 99% chance based on the Fed fund futures that the Fed does nothing. So if they did raise rates, it would be a big shock to the market. The Fed fund futures has a really high accuracy rate once it's above 85% going into a meeting. So at 99%, almost rest assured that the Fed wouldn't do anything to shock the markets. There's a 31% chance that they go another 25 basis points in November. So what the market is looking for is not what the Fed does tomorrow, because that's pretty much expected. They're not going to do anything, but what they say. Are they still hawkish? Are they a bit more dovish? Are they going to give us any indication of whether or not there's one more rate hike or two more rate hikes to go? Last week, we had the CPI and the PPI number. Both of them came in a little bit hot on the headline, but when you did the core ex food and energy, we knew those were going to be higher numbers. Oil's been going up. I'm sure somebody will ask about USO tonight, and food. I'm sure everyone knows it's been going to the grocery store, and that drives me crazy. Do a Fed soapbox speech oftentimes on the ridiculousness of having a CPI and a core CPI. They just kick out the things that raise the CPI. Anyway, I could go into greater detail on that. We'll do that at some other time, I am sure. But it's just kind of ridiculous that there's two different numbers when what should matter is what consumers pay across the board for the things that we need to live. All right, so taking a look at the market, you can see that we have a triangle pattern here. And if you go back just a few days, and we can walk the chart back, which is one of the really cool features of this software. If you're not familiar with it, People ask about it a lot. It's a private source from the Hub organization. You can go find out more about them at hubb.com. And there you can see the triangle that had formed. And then it looked like when that CPI number came out, which is this day there, that we were going to have an upside breakout. And then the next day we broke to the downside. And now we have come to where it looks like we're trying to sneak out the bottom side. But when you look at that, you can say, well, all right, it looks like perhaps we're breaking to the downside out of that triangle, but couldn't you make a case that you could keep that upper trend line where it is, extend it just a little bit more? And the fact that we haven't taken out this low back from the 25th of August and connect those lows and still stay in a bit of a triangle formation. I think you can make an argument there. And what we want to look at is the ADX. And as the ADX is diving down, it's telling you that we're consolidating. But you can see this little tick up in the ADX today. And that's where I always use the analogy of lava underneath a volcano. You look at the top of the volcano, it looks calm and serene, but we don't see the lava bubbling underneath. That's what happens when you have a triangle pattern, and then you have the ADX starting to kick up. It's telling you that breakout is about to come. And it does seem as though, Zach mentioned in the very beginning, that the market is waiting to see not what the Fed does, but what the Fed says tomorrow. That's going to be the key as far as where we go from here in the markets, I believe. So if we take a look at the moving averages, and I'll get these trend lines off, you can see that the all-important 50-day moving average was the high of the day. And so the fact that we moved up there on the high and didn't really take it out, closed right on it the previous 2 days, and then closed just below it today, tapping it on the high. It's close enough to where you can say that so far this is just a test of the 50-day moving average. But note that that wave 4 is only a 35% percentage retracement, so call it the 38.2% fib level. We could break down lower and create a new wave 4 at 50% or 61.8 and still have the potential for the 5-wave pattern to play out. Or we could turn and break from here tomorrow. And I do think it matters if the Fed gives any sort of indication that they're done. And I don't know that they will based on the numbers that we got last week. But if they did, I think you could see a pretty significant market rally and perhaps up to that wave 5 target around 480. But if they're hawkish at all, it does feel like the market wants to break to the downside a little bit. We are in September, historically the worst performing month of the year. I'm not a huge believer in the seasonality theories of the markets. They talk about, the election cycles and all that kind of thing. But historically, September is the worst performing month, and not every year, but historically. And May is number 2 if you're wondering what's the next worst performing. And that's usually because you come out of tax season in April, where everybody's last minute funding of their IRAs and 401ks, all that money rushes into the market, and then there's a vacuum in May. And so that tends to be a down month as well. So you have to take into account the fact that we are in September, I think. But again, who knows which way we're going to break out of this triangle. Those of you that have been watching for a while know the rules. Elliott himself said that triangles trump everything. When you have a triangle, even though we have a pretty well-formed 5-wave to the upside pattern here, you don't get caught thinking that this is going to be an upside breakout. Maybe it will, but we can break either direction out of a triangle. And when you see that, especially when you have that accompanied by low ADX, then you realize that we could go either direction. Major point, though, is that even a downside breakout doesn't necessarily wipe out the 5-wave impulse pattern. You would have to go down past that 61.8% level, get down to 70+% in order to disqualify it. So that leaves a bit of room to the downside. So that kind of wraps things up for the S&P. This is something that's a concern to the markets for sure. Interest rates just continue to climb to the upside. It's amazing to see the markets moving higher along these lines. And you take a look at the fact that by labeling that 5, we just barely took out that wave 3 high, just enough to label that 5. 4.7% up there is where we could potentially go. And this is what's really mind-boggling. And there's been a lot of chatter about this on YouTube. Look at this. 5.4% on a 3-month. So you can get 5.4% on a 3-month T-bill. And even Zach has asked about, should I put some money in T-bills? It's hard to say no to someone, even a younger person, which is mind-boggling for someone like me that was once a traditional financial advisor with the whole asset allocation plans, etc. When a person got older, then you would want a higher percentage into something like bonds or T-bills, etc., and less exposure to equities. But even for a young person today, how do you turn down 5.4% on a 3-month? It's unreal. And then you see where we are here on the 10-year. So we are pretty much at that 100% inversion once again. And I just feel like that can't be ignored. We just cannot ignore a yield curve inversion. I refuse to believe it. Perhaps I'm proven wrong. And I'll admit it if I am in time that we don't have a recession. And I know there's a lot of people that are feeling like there's no landing coming, so like a soft landing, that kind of thing, that we're not going to have any sort of a recession. I think we are. It just hasn't shown up yet. We have a pretty nice little ascending triangle formed here on that 10-year, and that could certainly break either way as well. But a break to the upside, you could see that kind of coincides with that wave 5 target. If it breaks lower, then it probably comes back down to test this wave 4 low here. And with rates going up at this kind of a clip, it's telling you that money is not flowing strongly into the bond market as you might think it would. And why not? It's hard to understand how rates are continuing to move up like this when it seems that the Fed is near the end of their rate hike cycle and probably closer, at least when you look at that yield curve inversion, to cutting rates. But yet rates continue to tick higher. So if money's coming out of the bond market, where's it going? It's not going into the equities market. So where's that money going? It's kind of confusing. And when you get these correlations, and a lot of chatter about that on YouTube as well with the last US market update that we did, people saying, well, how does this usually play out? Well, when you have these correlations between the bond market and the equities market, they do get out of whack sometimes, discombobulated, as I like to say. But it doesn't last long. These long-standing correlations between the bond market and the equities market usually work themselves back in to kilter, and I think that will occur. And so we'll see if we go significantly higher on this ascending triangle here. I would submit to you that that would be pretty negative for the Qs. We'll look at the Qs in just a moment, but continuing higher, it's just not going to be good for any part of the market, and is a little on the confusing side, honestly. Now the dollar has paused a bit, which makes a little more sense. I know there's some correlations. It softened against the yen today in front of the Fed meeting. There's some issues with the euro, etc. And so the dollar had this really nice run. And at this point, it's not in a 5-wave pattern. And we're sitting right here at resistance at 105. and having a strong dollar on top of interest rates to the upside is just really difficult environment for the equities market to move higher. It does seem like the equities market has wanted to move higher, but when then you throw these two wrenches into the mix here, it's pretty difficult for the equities market to gain ground, any sort of footing to move higher. So perhaps the Fed can alleviate some things by hinting that they might be done, or that they're at least going to pause for a while, and that could draw rates down a bit, perhaps soften the dollar a little bit, and give a little bit of a footing to the market. Or if they maintain their strong hawkish stand, even in the face of the yield curve going back the other direction, then I just don't see the scenario where the market can move significantly higher from here. We take a look at the VIX, and we just kind of hanging around this area. We broke below 13 a time or two, but not for very long. We closed below it there on the 14th and opened below it there on the 15th, but then closed higher. And so the 13 is maintaining its footing there. But notice the labeling here on the VIX. If you're bullish on the markets, this is something that you can hang your hat on, that there has been at the end of this wave 5. We had moved to a new wave 5 low, and then it relabeled to this 5 wave to the downside pattern, which would bring the VIX down to under 12. If that plays out, then that's obviously bullish for the markets. So perhaps that could lead us into thinking that maybe the Fed does come out a bit softer and a bit more dovish in their commentary tomorrow. And that allows the VIX to break down below that 13 level and gives the market the needed boost to break higher. Either scenario makes sense as far as how it can play out. And this is one of those times where you just wait. And that's what we've been doing. We haven't sent out a lot of new alerts at ewotrader.com because it's just, when you have this kind of environment, it's not the smart thing to do. It's not the prudent thing to do. There's plenty of room either direction when the market breaks out of this consolidation. So let's let it do it. And once it does, then we can take advantage of that directional move at that point in time. But there's no reason to step in front of it and try to predict which way things are going to go. It's going to tell us. Let's just listen to what the market wants to give us. Looking at the rest of the U.S. markets here on the DIA, you can see that very similar pattern here, not quite the same doji, but we did trade lower and close higher. And we're right here at that 345 level, which I think kind of needs to hold here. The wave 5 ended at 75%. It's still colored green, so that means it's still the current wave. But if we break much lower, I think that turns purple, which means that 5 is done. And then we start looking to come down here to the previous 4 in the area of around 335. At this point in time, we could break higher. We don't have, I mean, you can draw a triangle here. It's not as clean of a triangle as it is over on the S&P, but you can still see a bit of a formation there with the attempt to break lower. So that's kind of in play there. And then if we look at the Qs, which I know everybody's always interested in, and not as bad as you would think, at least not as bad as I would think, considering what I've shown you with the dollar and rates, etc. This could look a lot uglier than it does. I'm actually pretty impressed that the Qs have held in there as well as they have. Yes, they've pulled back a bit, but notice the Qs actually closed above the 50-day moving average, believe it or not. So staying stubbornly strong here so far on the Qs. And when you look at that, you could clearly see a continuation to the upside here. We only went to the 23.6% fib retracement level here on the Qs, and Elliott didn't even really call that much of a correction. He called that more of just a pullback within a bigger impulse wave. But again, plenty of room that we could break lower, move the wave 4, and still have a qualified 5-wave to the impulse pattern higher. And if we look at the IUM, and I might finally get what I've been surprised hasn't occurred yet. You remember me talking, back here in August with these two moves that I was a bit surprised that we came down that far and didn't test 180. We had tested it back in June, so it's not a requirement to test it. It was just surprising that we got that close and then rallied back above 190, although it was only for one day, no follow-through day, no confirmation, all the things that we talk about all the time. And so now here we are, just really very close to testing that 180 level once again. We've been in the 170 to 190 range for a while, and then we tightened it to 170 to 180 through this area here, broke above it, came down, tested it, got back above 190. Looked like maybe we're going to start to look at the 190 to 210 range again, but nope, short-lived, back down here. So at least technically we're in the 170 to 190 range again here on the IWM, and we'll see what happens if indeed we do come down here and test that 180 level. Just a reminder that whipsaws occur frequently on Fed announcements. So what you see right after the announcement quite often gets retraced. So you just let it play itself out, and we'll see what happens tomorrow. That's going to be the key, and we'll have more information for our alert subscribers on Thursday night's insiders meeting regarding how the market reacts to that. Oftentimes, however, it ends on a Fed day, gets retraced the following day. So the initial move does, and then oftentimes the next day retraces whatever the ending move is. So you kind of have to give it a day or so to play out when you have Fed announcements. And as I said in the beginning, for those of you that may be just joining us, it's not about what the Fed does tomorrow that the market's looking at. It's about what they say. That's what the market is fixated on where we go from here. So they test that 180 level. At least I can say that, okay, that makes more sense. I'm sure the market really wants to make me feel better about the fact that the IWM came down and tested 180. So just a bit facetious there. Bitcoin trying to catch a bid again. So 26,000 held. We did come down and tap 25,000, which was the absolute low barrier there. That was the KD bar the door area there, Zach. We needed Bitcoin to hold 25,000, because if it didn't hold that, there's nothing. There's a big void to stop it from likely coming all the way down to this previous floor. But it did hold. No follow through on this closing price here. And I know trades 24/7, but it does give us closing prices just like futures, etc., for end of day software programs. And so no follow through day. Back up above 26,000, up above 27,000 at the time of this webinar. So as we're live right now, Bitcoin is above 27,000. We'll see if it can continue to make its move. The halving, whatever occurs the first quarter of next year is the expectation. And historically, you know the story, I've told it enough times. Every time, 6 to 9 months ahead of that, the cryptos, especially Bitcoin, have rallied. Maybe that starts now. Pretty interesting to see with the weakness in the equities markets, this continuing up like that and holding this level. Seemed like it was perilously close to giving up 25,000, and then we would have been looking at 20,000 once again, and that would have been problematic, I think. So looking at a couple of the international markets real quick, we can see the EWA in the Australian market. Nice little triangle formation here as well, right around that all-important 22 level. And I've talked about that level so many times. We did break it in August, and I was very surprised that we broke below not just 22, but this area right through here, just under 22. We broke below it and we're able to hold there and bounce back up and consolidate into this triangle. Very surprising to me. I thought that once we broke where that red line was, it was down we go, and looking at possibly 20 to the downside on the EWA, but it managed to find itself and hold in that area, and we are above 22. We did trade above the 50-day moving average, closed below it, but above the 10-day moving average. So not too bad there. Clearly a triangle, so a breakout coming there. And yeah, the triangles are still there. In the comment that was made on the YouTube video, not this past weekend, but the weekend before, when I was talking about the triangles, that you see triangles in your sleep. Well, you do right now. If you're watching the markets, because they're everywhere. And there's one also on the EWC for Canada. So there you go. Not quite as well formed. You don't like these big gaps here. The more times you touch a trend line, the more definitive the triangle is. It's pretty good on the set of higher lows, not as good on the lower highs because of this big opening here. It is nonetheless a triangle right at that 35 level. It's got a little bit of room there. 34 is the really important level on the EWC that needs to hold. And I think you can see that all these levels are in play here if we do get a downside breakout in the market. All these levels can get taken out pretty easily and set ourselves up for higher lows. Looking at the INDA for India, which has just been amazingly strong and continuing. So got a little bit overbought here. No security in any time frame, gets very far away from the 10-day moving average, another rule. And so we got a little bit overbought in this area right here around 9/11, and then came back down, and we've tested the 10-day moving average, still above the 10-day moving average. And as long as we hold above this level here around 45, where that previous wave 3 high is, still very strong looking chart on the INDA, far and away, in my opinion, the best looking chart internationally, the INDA, and the opportunity to go up and hit that wave 5 target. Now we break below 45, that changes everything. But as long as we stay above 45, then you, I believe, need to stay bullish on the INDA. We break below it, then we reset and we take a look and see where we go from there. Last but not least, on the EWG, you can see that we're down here at 27, and in an area where we could look to come all the way down and test that level around 26. If we can't hold in this region, bit of a doji here on the EWG as well, perhaps waiting on what occurs in our market. But notice where I drew that red line also intersects with where that wave 5 tap box is. That's time and price projection. Those are projection levels that the Elliott Wave algorithm sets. And just to be really clear, because it comes up on YouTube and social media comments all the time, these are not my Elliott Wave levels. What I do is interpret what the Elliott Wave algorithm shows you, and the algorithm in this software, again, profit source from hubb.com, is programmed exactly to the algorithm as Ralph Nelson Elliott wrote it. So this is the Elliott Wave algorithm labeling these. I just do my best to interpret it for you. And so what it's saying is that if the wave 4 were to begin now, that's an area where it might find some support or resistance, however you want to view it, before moving down to making a new low. But we are in the wave 3. We could continue lower in the wave 3. In fact, the wave 3 could come all the way down to where that wave 5 target is. For some reason, the Elliott Wave algorithm likes that price around 26.25 there on the EWG for an eventual price target there. So whether or not we go down there first before we bounce, or bounce first and then go down there, it seems to think that there's an eventual spot there around 26.25 on the EWG. So that wraps up the international markets. got a really interesting and very cool case study to show you from our alert service at evotrader.com. Give you an idea of what we do. This was in our time strategy. This is our AI-based time strategy where we expect stocks to stay in a sideways move. And sometimes, especially when you get into a market like this, stocks break from that, the AI is not 100%, nothing's 100%. And we look for stocks that have had a big move to the downside, and then the AI analyzes it on the likelihood of staying in one standard deviation. Well, if you put on a time spread or calendar spread, as we did here, and the stock breaks lower, then you're likely to get a sign on the short option. Well, that gives you some flexibility because we have a long option to protect it. So you're never just sitting out there worrying about assignment without protection. And so you can see that we post comments here. And so when I post a comment regarding this, it gets posted here. So as I mentioned, oftentimes the difference between the case study considerations that we find at TradeFinder versus the trade alert service at evotrader.com is that we send you out alerts on entries, exits, and adjustments. And we kind of guide you through the whole way. And that's what these comments are designed to do on if you had got assigned, if you got partially assigned, etc. Make those comments. And in this case, the stock was moving lower, expected it to continue to move lower, and it did. And what we did was, once we were assigned the shares, sell the shares and held the long put. And you can see as the stock continued down, you've got a long put that's in the money. It got to the point where we were a bit oversold here. So it was time to go ahead and say, let's sell that put and close the position out. And the fact that we were holding a long put, and there was a lot of contracts, this one wasn't very expensive to get in, 12 contracts, you can see at 24 cents a piece on the initial move to get in. And that's why so many contracts ended up with a 377% gain on what was supposed to be a sideways strategy. And it broke to the downside, kind of breaking out of that trading range that the AI said it might stay in. And so it shows you the power of the adjustment process and where you can go. And the fact that we'll give you commentary along the way of telling you what to do. And you can see right there the comments that are posted. So ending up with a very nice return here. It ended up being directionally based. So you don't want to hang around too long because the idea is for these to trade sideways and generate income. But the weird thing is it was only 21 days, which is the average time for one of these sideways trades in the time strategy. You need a little bit of time to erode time decay in the short option. Well, when they assign you the short option, they're giving you all that time premium that you're trying to keep. And so then you make a decision. All right, do you just take that and go? Do you hang on there? And in this case, clearly, with the look that the stock was not done going to the downside here, it made sense after breaking that support level there at 9. And you can see when you're that far in the money with 12 contracts, yeah, you can generate a nice return in a really short period of time. So you have a 10 strike put and you're $3 in the money. Yeah, you can see where that nice return came from. So this is not the norm. This is unusual, but it's nice when it comes to be, and you don't have to have too many of those to make your year. So I'm pretty excited to show you that one and a really cool risk graph here. So you can see the position was a loser at one point and ended up being an extremely nice winning position. So that was fantastic. That was a fun one. All right, so let's get back and review our case study considerations going back to August 15th here on Home Depot. And that was the setup there. Now I'm going to walk you forward on this again because we weren't together last week. And so if we take a look at where we would have been moving towards last week, we had set that wave 4 and give it time to see if that wave 4 goes up and occurs, and now we're getting to the area of sideways consolidation. You can see forming a bit of a triangle here, very similar to what's going on in the market. And this kind of made sense from a fundamental standpoint. The fact that people aren't selling their homes, nobody wants to leave their 3% mortgage and either upsize or downsize to a 7, 8, 9% mortgage. Even if you're downsizing your house, you more than double your payment and for less house. It doesn't make any sense. And all the builders are building multifamily homes now. So they're all building apartments. That's what's going on in the area where I live in Florida. Very few single family homes are being built, but several different apartment complexes are being built. That's the name of the game right now. So you would think, okay, you can make a fundamental case for this. And then you can see that we've broken to the downside. And with that move there, now you have to decide, okay, do I want to hang around here? And there's what can occur from a triangle when you get the breakout and you move lower. And so now we're down in an area of support here around 310. So if you're still following along with this one, obviously it's in a losing position right now with this downward breakout of the triangle. At this point, you might as well hang on and see what the Fed says tomorrow. And we look at the moving averages here. You can see we are oversold. So it wouldn't make sense to exit if you had a call or something to the long side with it being that far oversold, being at an area of support. And with that Fed announcement tomorrow, it may be that the thing to do is to exit this, but I think you probably get a little better price with a little bit of a bounce back up towards that 10-day moving average, even if the Fed is still hawkish tomorrow. So I would keep an eye on that. Then we have the SPY we've talked about, and that out of the money butterfly around 430, 420. And so we have that for October for our alert subscribers. And that's starting to gain a little traction on this downward move. When you set up an out of the money butterfly, you don't have to have the stock come within the wings. Just a directional movement in your direction allows it to gain value. And so that butterfly on a downside breakout would become nicely profitable even before the market broke that 430 level. If it breaks back to the upside, then we had some low cost protection in case we moved lower. And that's what we had talked about here. And looking at rock, and that was we looked at back on the 29th. And so moving forward here, again, had a pretty nice move to the upside. So after a couple days, we had moved nicely higher. So we were at 75, and then 2 days later, we're up at 76 and change. So moving in the right direction, and then back to test that 70 level. And you can see holding as support here around 70. Couple worrisome days here on the 11th. That's the 13th of September. Looked like maybe we're going to go down and fill this gap. Nope, came back up. And then once again here on the 15th, looking like we're breaking lower again, but no follow through on any of these attempts to break below 70. So far, the 70 level is holding. And as long as it does, you stay long. It just depends on if we break that level and it wants to come down and fill this gap first or wait. That'll be very interesting to see. And then DVA that we had looked at to the downside 2 weeks ago. And then moving forward here, we had continued lower for a couple days. So you can see that's where we were on the 5th. So trading at 96, and then we went down to 95 and change, so $1 lower, and then kind of holding here with an attempt to move back to the upside. If we get another close above the 50-day moving average, I would say exit that one, and take that as a loss, exit it. But if we break back below 100 tomorrow, then we still have the possibility, and you can't rule out with this wave 4 sitting here, and the fact that we have the wave 5 that only went 75%, we should come back to that previous 4. That's what's supposed to happen. And so the move up above the 50-day moving average today would be troublesome on a downside trade here. But again, you have to have follow through. So we look to see, do we get another higher close? If we do tomorrow, then again, I think you take that off. If not, then you hold it. And then we still have a strong possibility of coming down and hitting that wave 4. Still think that'll get hit. It's just a matter of when. And that's part of options trading, isn't it? It's not just being right on direction. It's being right on direction and doing it in a time frame that allows you to profit from options, which, as we know, are depreciating vehicles. All right, so let's see if we can find anything for tonight. And it's kind of challenging going into the market tomorrow with the Fed announcement being so heavily watched with that triangle. We do have a few potential bullish positions here. AFLAC is the first one there that I would find interesting because you can see it's trending to the upside, and that makes sense. It's in a category that's known as being defensive. It's not in the sin stock category: tobacco, alcohol, and gambling, the 3 primary sins that we have that are viewed as places to hide when the economy weakens a bit. The viewpoint being those are our vices, and we're going to find a way to drink, smoke, and gamble no matter what's going on in the economy. And I'm not, that's the viewpoint, and I'm not condoning it. I'm just stating that's why money rotates that way. That's the pervasive view when the economy is weaker and some of the higher beta things are not nearly as attractive. So looking for a move higher here in AFLAC, right at a 38.2% fib level, wave 4 correction. So if you looked at this, you could say, I like that move to the upside. And if you're aggressive, you could go ahead and enter now. And as you know, I usually give both an aggressive and a conservative type of a viewpoint. If you're a touch more conservative, you would want to see it break above 78 first. And if it breaks above 78, then you're in. So when you look at that, it's set up awfully well. Got a pretty good looking DMI that is suggestive, or at least supportive, of the possibility of breaking that resistance level. And I think if it does, then we do go up and hit that target. But we got to get above 78 first. If we do, it's all clear. You can see it's clean air. The racing analogy, when you're out front, you're in clean air. You don't have all the hot exhaust and little pieces of rubber coming into your radiator, etc., like you do when you're in the middle of the pack. So a break above 78, and I think we move higher. So it's in an area that should do okay, even if the market doesn't do well. And I think today bore that out. We had a, although slight, pretty tough tape for most of the day, and then turn and move back to the upside. So we'll go ahead and list that one with an asterisk, because I do think caution should be noted at this point in time. So what I'm going to do is going to write on this, the target price there is 83 with a break above 78. So we're going to go ahead and add that slightly cautious caveat, since it'll be a week before we talk again. And if that occurs, then you can look long there. But with the triangle pattern in the market and the fact that who knows what the Fed's going to say tomorrow, making any sort of directional trade is challenging at best. And you might say, well, why don't we just put a strangle on the SPY? Well, it would be too expensive to do that now with premium that's been built into the options. I'm expecting some movement tomorrow on whatever the Fed decides to say. So with that, Zach, I will bring it back to you and see if we have any questions.
Sounds great. Yeah, lots of wonderful questions flowing in per usual. We have a very educated subscriber base, so it's always a pleasure to interact with you all. And with that, we had a subscriber, this too shall pass, who wrote in saying that you are now one of his favorite YouTubers, as nobody else has. A lot of people don't realize that and have been calling for under 25K. So just wanted to pass through the positive feedback. It's not often people will take the time to share that, so we do appreciate it. And just to add to that, for anyone out there that feels the same, if you don't mind smashing that like button for us, we certainly appreciate it, and it goes a long way.
Thank you for the comment. It is very much appreciated.
So we're going to start out with a question from Constantine on Zoom. Today, we filled the last week gap in the E-mini futures. When the new quarter has been activated, who leads, the future or the cash XPX?
Boy, that's a really good question. Historically, it's been thought that the futures are the leader. There used to be a time when you could trade, the difference between the futures and the cash market and make some money on the arbitrage. Mr. Henry, that owns the Boston Red Sox, made his fortune doing that, simply trading arbitrage between futures and the cash market. They've kind of fixed that to where it's not such an easy trade anymore from the pricing, but it used to be that, and they're oftentimes not the same. But when you get to expiration, they have to come together. And so you could go long one, short the other one, and basically have as close to a no risk trade as you can get. But that's in the past. So we no longer have that opportunity anymore. They've taken that away, but he's an example of someone that made a whole lot of money on that kind of trade, exactly what you're talking about, Constantine. So the viewpoint is the futures are the leader, but it's not as defined as it once was. But as I talk about, oftentimes it's viewed that smart traders are in the bond market. They're very smart traders in the bond market to understand how the bonds work, etc. And that's why you always want to have at least a working knowledge of, well, you don't have to be a great bonds person or anything, but just have an understanding of what goes on in the bond market, that prices and yields move inversely, etc. Because it does matter in the equities market. There's more money in the bond market than there is in the equities market. So the thought was the same on the futures, that very smart people trading the futures because of the amount of risk, the leverage that's involved in futures and the amount of risk. So that's been the viewpoint, is that the futures are the leader. I don't know that it's so distinct anymore that we can rely on it, though, unfortunately. So I know there's kind of a in between type, non-committal type answer, but that's just how things are these days.
Very well. All right. And so we will go over to this next one here from Lisa. I'm actually really excited to hear your thoughts on this. I'm sure you're aware of everything that's been going on with MGM and that cyber attack that's basically shut down all of M resorts for the past, I don't know how many days, but I know they're still down, and looks like there's probably going to be a bit more of that before recovery. So just very, very excited to hear your thoughts on this one.
Yeah, especially since all of my rewards points are M points in Las Vegas, so definitely a direct effect on me, because who knows if you're going to get your points back or what's going to end up happening with all that. So yeah, I do have definite knowledge and experience with what's going on here. and also have a friend in Vegas that was talking about it to me as well, sending commentary and giving me some ideas on how to make sure that I don't lose my rewards points based on the chatter of what's going on out there. So yeah, it's pretty wild stuff. Pretty significant cyber attack, and as you can see, has hurt the stock pretty significantly. Interestingly enough, not in a 5-wave to the downside pattern. Several zigzags though that are occurring, and interesting to see this first zigzag where we came down to the 61.8% level, went back and tested 38.2, just as classic as the Elliott Wave and Fibonacci stuff gets. And then you move down to 100%, and that could have been the end of it until today. And we break lower. And so the next level would be 161.8, which would be to a 38. You can see that perfect 38.2% fib level correction. 161.8% extension when you have a 38.2% correction is the same as a 261.8% extension is when you have a 50 or 61.8% correction in the B wave of a zigzag. My point is they happen, but not that frequently. So this is extreme, I guess is what I'm trying to say. And so we have to watch that. There's a tiny bit of potential that we could hold right here where we closed. We are just a touch oversold on today. But man, if that doesn't look like it wants to go down to that 161.8% extension, and then when you look at the DMI, it's about as strong as you can get, or as supportive as you could get for the directional move to continue. In this case, a downside move. So the best thing you have going for a bounce in MGM is the fact that it's oversold and at the last possible point of support. Otherwise, it looks like at least the 161.8% extension. But you can't, I just don't think it would be wise to jump in now in this oversold state. Perhaps we come back up and test this 100% level and let the 10-day moving average catch up. And if we can't break above it, then you have your potential move. So the trade would be from that level back down here. So if we do bounce up and test that 100% level, let the 10-day moving average catch up, I think that could be a downside entry to the 161.8% extension. But I couldn't chase it now. It could hit that 161.8% level tomorrow. The 10-day moving average rule works extremely well. Nothing stays overbought or oversold from it for very long, but could it go one more day and have a real ugly day and get really overextended? Yeah, it could. So in that case, and say I would miss it, but just knowing this rule and knowing that we're oversold right now, I couldn't jump into the downside tomorrow. But a test of that 100% level would be pretty interesting to move to the downside, and let's just hope I get all my points back on the rewards side, because that's
Lisa was actually just there during that
Yeah.
that whole debacle, the whole incident that they're still currently dealing with. And Lisa said that they informed that you will receive those points once they are back up and running and just are able to even access their UIs and just everything that goes into running the massive city of Las Vegas. So just one more
Thanks,
thing.
Lisa. I appreciate that. Makes me feel better, and I hope you're right, and that they were able to track them down, and that whatever happened didn't just completely wipe the database.
Right. Now, yeah, I think they'll have some type of assurance there. And just wanted to add, out of, one of the things I've absorbed out of the wealth of knowledge that you offer is that when the market is providing conditions that seem just too good to miss out on, it's usually not going to follow through that way. So as much as getting in on that downside play is enticing, it, like you said perfectly, just seems a bit too good to be true. So have to follow out on that one.
Yeah, I just don't think you can do it right. And there may be a downside trade if it tests that 100% level, but as far as right now, I just think there's too much risk there. And I don't know, we'll see tomorrow. I could be wrong. It's happened before and it'll happen again. So.
Alrighty, and so we're going to go over to Meta. Young from Zoom would like to look at that, and there's a few requests and from the YouTube chat as well.
Okay. Meta performing really amazingly well. And look, after this huge run, and it became a darling of the institutions after they just trashed it when they came out with the whole metaverse and all this money that they're going to put towards it. And we get down near, $80-90, and then it just rocketing back to the upside. They stopped all that talk in their earnings calls, etc., focused on the core business, and the institutions started loving them again. This kind of movement here that's the classic, that's accumulation from institutions. When you see that kind of a 45-degree angle with these smaller bars just climbing up and very minimal corrective moves. And then we come right to the 23.6% fib level, and that's the end of that. And then we're moving back up again, up today. This does seem to be, for whatever reason, a place to hide right now. You got to feel like it got so hated. And this is one of the things that we talk about as, we look at the market right now and there's so much negative, right? Everything is negative. The yield curve, rates going up, dollar going up, everything seems to be against the market. How could the market go to the upside from here? Well, that could be all the market needs. When everyone views the market one way, the path of least resistance is the opposite direction, whether it makes any sense or not. That's how the market works. So if enough people are just doom and gloom and bearish on the market will go higher just because that's where the easy money is. The path of least resistance will be that way, and we'll find out if we're that one-sided in the market. That's what it takes, is everybody to be on one side and the market goes the other way. Now, if the market does go to the downside, it seems like the institutions are wanting to hold their meta positions here. They've not dumped them as they have some other stocks. It's held in there pretty well. And I would say not even just the 300 level, but if you hold 280, I think you can stay long here on Meta and see if we climb to the upside with that potential target up there around 390. If it gets to 390, it seems logical that it'll go to 400. But it's above the 10, 30, and 50-day moving average. It's above that support at 300. So if you're a little more cautious, if it broke 300, you could get out. If you're a little more aggressive, you could give it to 280. If it broke that level, though, I think then you have to bail and see where the bottom ends up being. But for now, good looking chart, and good on you for picking that one, because there's not much looking better than that right now.
Yes, good spot. Always one that is interesting to follow up on, especially with macro effects that we never know with this industry here. So we'll go into a question from Manuel on YouTube for NAK. NAK.
NAK. Okay. Yeah, social media is a wild place. And so
that looks like it's NAKD. Yeah.
NAK.
Let me double check that.
Yeah, I don't think we have just plain NAK.
Yeah, NAK is possibly an OTC. So sorry, Manuel, if it's not, we will be able to.
Let's see here. It's on the Amex. We should have that.
Yeah, it's
yeah, we do. It's
Dynasty Minerals.
This is a penny stock, and difficult in the Elliott Wave world because there's just not a lot of liquidity here. Elliott Wave works better with the more liquidity, the better here. So that it becomes challenging on these penny type pink sheet stocks, but it's not on the pink sheets, on the Amex. But when you look at, you can see a couple zigzags there, and perhaps they've played out. Let's see. Not a stock that I'm So it's giving us a weird reading there on that, but so there it went to 161.8, so it got to an extended level there, and so that I don't know what to tell you now at that point. The fact that we're at 161.8, that's where we should go now. It did test the 100% level on the low today and bounced. That's what it would need to do to go to another level, and the algorithm does like this price here around 47 cents. So I think you trade that at your own risk. That's money. That's play money that you don't care whether you lose that money or not. And if you're looking for something, perhaps it can continue higher from here, but know that it is already hit an extended C level, and it wouldn't be out of the realm of possibility that that's the end of the move. But it is showing some sort of like at that price around 47. So if you wanted to just hold your nose and jump in, take a shot at it and see. But that's a risky one there.
Yes, indeed. And I see we are 2 minutes after the hour. How about we finish with 2 questions from our friend Will?
Okay.
So first one is going to be FedEx. What are your thoughts about earnings going into earnings tomorrow?
Yeah, man. You're getting mixed signals from packaging companies, etc. And the commentary has not been positive, and so I think there's some concern going into not just this earnings report, because remember, that's only half of it, right? And when you have an earnings report, you have the earnings, but then you have the guidance, and that's where I think the concern is. That even if the earnings report comes in okay, pretty concerned about where they're going to guide, and I think that could get a bit dicey. We're only at a 20% wave 4 correction. I'd be pretty concerned about that one going into the earnings report tomorrow. It would be if they come out with a positive earnings report and positive outlook, that could be really good for the economy. But that would surprise me. Not that that's any big deal, whether I'm surprised or not, but the market certainly doesn't care about that. But I'm pretty cautious going into that is the way I would view it.
All righty.
What was the second one?
For the second one, before I give it to you, I just want to say thank you to everyone that joined and participated this evening. If we didn't get to your question, please know it has nothing to do with the validity of the question. We just only have so much time in this free live stream that Rob provides. So please take that as encouragement to attend the insiders meeting, where we have a 45-minute Q&A portion and a much higher likelihood of getting your question addressed there. And lastly, we have Google. Why do you think Google is the old Alphabet is refusing to sell off?
Well, this was from Will as well. Will, this was on my search this morning. It wasn't on the one that I updated tonight, but it was very difficult to go long anything today, but it was on my bullish search. And so it's been pretty darn stubborn. And as a reminder, even in times when the economy is rough, liquidity is rough, which it is right now on both fronts, and I think some sort of recession on the horizon, the money has to go somewhere. By securities law, money that comes in through IRAs, 401ks, dollar cost averaging programs that come in every single month, the institutions are only allowed to keep a certain amount in cash. The rest has to be put to work by securities law. So it has to go somewhere. And so they try to find where they view the safest place. And the safest place is the things we use, right? I mean, you look at a company like Procter & Gamble, stuff like, I'm not recommending them, just giving an example. Toilet paper, stuff that we still have to use no matter what's going on. I gave you the Send stocks thing earlier. Apparently there's a viewpoint that Google is is something that we're just, it's an adjective now. I feel like the institutions are pretty comfortable with keeping money there, obviously, which is why it hasn't sold off. So that's the answer to your question. Institutions are comfortable, at least for now, parking money there, and whether or not they continue to be remains to be seen. But the stock's still above the 10-day moving average. It still looks awfully good, and we still have a pretty decent, not great, but pretty decent DMI. And the most important thing is, I would say, is that the negative directional indicator isn't really trying to show any sort of move to the upside. So I feel like, at least for now, and that could all change tomorrow, right? I mean, if the Fed comes out hawkish and we have a 500-point down day tomorrow, then Google probably starts to sell off. But I feel like, so here's the way things go when the market sells off. The generals go last, and Google's a general. So the other really high speculative stuff will get sold off first. They'll hold on to the big boys, the generals, until they go into forced selling. And if we have a movement to the downside, because just like I gave you the rule that a certain amount of money has to be put to work, they can only keep X amount in cash, they have to have X amount on hand as well for redemption requests. So when you start to get a market downside, and if you're wondering why does the market always go down faster than it goes up, clearly we know fear is a more dominant emotion to greed. Fear and greed drive the market, so that's part of it. But the other part is it snowballs. So when things start going down and people get nervous and the fear comes in and people start selling, well then, if there's enough selling, institutions are forced to sell. That's where the term forced selling comes in, to have enough cash on hand to meet the requirements for people that want to continue to redeem. So you get the snowball effect to the downside. So those two things combined are why the market always goes down faster than it goes up. The old adage, market takes the stairway up and the elevator down. And you can see that it clearly looks like stair-stepping move to the upside there on Google. So I hope that's not some sort of a premonition there. But Google will be one of the last to fall. They hold on to those as long as they can. But if the market does correct and it gets to the forced selling point, Google will eventually break and they'll have to start selling it. But clearly for now, they're content in holding it there. They're a cash printing machine, so it's not a bad place to put money, honestly. So I can totally understand it. But great questions as always, everybody. Thanks so much for your attention. Watch what happens tomorrow. Don't get sucked in tomorrow. Let Thursday play out, and then we'll see where things go after the dust settles on Thursday, and we'll have a much better idea then, and we'll certainly cover that in the weekend update. So have a great rest of your evening, and look forward to talking.